You know what flipped my trading from random wins to consistent confidence? I stopped treating support and resistance as static horizontal lines. Instead, I started seeing them like rivers, flowing with the market. That's when everything changed. Because the market doesn't move in a straight line. It flows, it bends, it breathes. And today, I'm revealing one of the most underutilized strategies in trading: dynamic support and resistance using the Exponential Moving Average, EMA. Most traders think support and resistance means just drawing lines on a chart and hoping price respects them. But the truth is, those lines get broken all the time. Fakeouts, whipsaws, break retest fails. You know the feeling. You wait for price to bounce from support, and it breaks. You short the resistance, and boom, price explodes. That's because you're using static tools in a dynamic market. It's like trying to read the ocean's currents with a ruler. So let's fix that. The Exponential Moving Average, or EMA, is different from the simple moving average. Why? Because it reacts more quickly to price. It gives weight to the most recent candles. It bends with momentum. It moves with the rhythm of price. Think of the 21 EMA, the 50 EMA, and the 200 EMA as moving zones of interest. These are floating levels of support and resistance, followed by smart money, institutions, and algorithmic traders. Here's how I use them. The 21 EMA is your short-term dynamic level. Think intraday trend. The 50 EMA gives mid-term context, often respected in strong trends. The 200 EMA is the grand master, long-term institutional level. If price is above the 200, we're in bullish territory. So what's the strategy? It's simple but deadly effective. Wait for price to pull back into an EMA zone, like the 21 or 50. Watch for signs of rejection, wicks, pin bars, engulfing candles. Add confluence. Maybe price aligns with a recent structure or a Fibonacci level. Once price reacts, that's your signal. Enter on the bounce. Stop loss just below the EMA or previous low. Take profit at the previous high or next supply zone. Let me give you a real-world analogy. Imagine a bouncing basketball. Each time it hits the floor, the EMA, it gathers energy for the next jump. But if the floor cracks, it falls through. That's your signal. It's not a bounce, it's a shift in momentum. Now here's where it gets even better. Stack these EMAs on multiple time frames. Let's say on the daily, price respects the 200 EMA, but on the 4-hour, it's bouncing off the 50. And on the 15-minute, you see a clean rejection from the 21. That's multi-timeframe confluence, and it's powerful. But let me be real with you. No strategy is 100% perfect. There will be fakeouts, there will be noise, and you're learning to flow with it. Trade smart. Let the market come to you, and let the EMAs guide your path. You're no longer trading random lines. You're riding dynamic rivers of liquidity.